Have you ever wondered about the basic principles of accounting? Let's start by understanding the separate entity principle. In the world of accounting, the separate entity principle is a fundamental concept that sets the stage for how we record and interpret financial transactions. This principle is based on the idea that business transactions are separate from the personal transactions of the business owner. It's like imagining a clear, invisible wall that separates the financial activities of a business from the personal finances of its owner. Picture this. You own a bakery and you've just bought a shiny new car for your personal use. Meanwhile, your bakery needs a delivery van. You purchase one. Now, according to the separate entity principle, these two transactions are recorded separately. The car, being a personal purchase, is not recorded in the bakery's books. The van, on the other hand, being a business purchase, goes straight into the business's financial records. Why is this principle so important? Well, it's simple. It ensures that the financial records of a business are clear, accurate, and free from personal financial clutter. This helps business owners, investors, and creditors see a true and fair view of the company's financial health. Let's take another example. Imagine you're a business owner who decides to loan some personal funds to your business. Even though it's your money, according to the separate entity principle, this is considered a liability for the business. It's now something the business owes, not an owner's free cash injection. The separate entity principle also comes into play when it's time to pay taxes. Personal and business taxes are calculated separately based on the income and expenses recorded under each entity. Mixing business and personal transactions could lead to confusion and potentially serious tax implications. So, as you can see, the separate entity principle is a foundation of accounting, keeping personal and business transactions distinct. This principle ensures transparency, accountability, and accuracy in the financial world, providing a clear snapshot of a business's financial position at any given time. Moving on, let's dive into the money measurement principle. This principle is one of the cornerstones of accounting. It dictates that a business should only record an accounting transaction if it can be expressed in terms of money. Sounds simple, right? But let's delve a little deeper to understand what this truly means. At the heart of the money measurement principle is the concept of quantifiability. For a transaction or event to be recorded in the accounting books, it must be possible to measure it in monetary terms. This principle is crucial because it provides a common measurement unit that simplifies the process of recording and analyzing financial information. However, there's a catch. While money provides an easy-to-understand measurement unit, it's not perfect. There are certain aspects of a business that, although incredibly important, cannot be measured in monetary terms. I'm talking about factors like employee morale, customer satisfaction, or brand reputation. These elements, despite their significance, do not find a place in the financial statements due to the money measurement principle. Now, let's illustrate this principle with an example. Suppose a business purchases a piece of equipment. This transaction can be measured in monetary terms, the price paid for the equipment. Hence, it is recorded in the accounting books. But let's say the company also spends time training its employees to use this equipment. While this training is crucial for the business, it cannot be quantified in monetary terms, and hence is not recorded in the financial statements. So, what's the takeaway? The money measurement principle is a guiding light that helps businesses focus on transactions that can be quantified in monetary terms. It provides a consistent, measurable scale for recording transactions, making financial statements more straightforward to understand and compare. However, it's crucial to remember that while the principle simplifies accounting, it does not capture every facet of a business. Some vital aspects, like the ones we discussed, may be left out of the picture. Thus, the money measurement principle helps to keep business records focused solely on quantifiable monetary transactions. Now let's delve into our final principle for today, the going concern principle. Imagine you're in the driver's seat of a business, steering it in the direction of your dreams. In the rearview mirror, you see your achievements, while the windscreen offers a clear view of the journey ahead. The going concern principle is essentially that windscreen. It's the assumption that your business will continue to operate indefinitely, allowing you to plan your route with confidence. This principle is a fundamental cornerstone of accounting. It impacts how assets and liabilities are recorded, and when revenue and expenses are recognized, it's like laying the foundations for a building. You don't lay foundations for a shack when you're planning to build a skyscraper, right? You plan for the long haul. That's exactly what the going concern principle enables businesses to do. Let's take a hypothetical company, A1 Enterprises, as an example. A1 Enterprises has been doing well and plans to expand its operations. They've decided to invest in new machinery that will increase their production capacity. However, this machinery is expensive and won't pay for itself overnight. It's a long-term investment. Without the going concern principle, A1 Enterprises might hesitate to make this investment. After all, if they were not sure that they would be around for the long term, it would be risky to commit to such a significant expense. But the going concern principle allows them to confidently plan for the future, assuming that they will continue to operate and eventually recoup their investment. The going concern principle is not just about optimism, though. It's about making informed, strategic decisions based on the assumption of continuity. It encourages businesses to invest, grow, and develop, knowing they have time on their side. However, it's important to note that the going concern principle is an assumption, not a guarantee. Circumstances can change and businesses can fail, but with this principle, the accounting world gives businesses the benefit of the doubt, allowing them to plan and operate as if they will continue indefinitely. In conclusion, the going concern principle allows businesses to plan for the long term, assuming continuity of operations.